Financial Frontiers, June 15, 2026. 1. Corporate Treasury and Cash Flow Management. CFOs launch real-time cash strategies to fuel growth. Corporate treasurers are rapidly reinventing how companies manage cash flow amid a changing financial landscape. In high-level strategy sessions this week, chief financial officers, CFOs, of major e-commerce firms emphasized real-time liquidity control and adaptive cash strategies as keys to resilience. With global interest rates still elevated compared to a decade ago, many corporations have enjoyed strong interest income on their cash reserves and are seeking innovative ways to deploy these funds for expansion. The talk of the day at an industry summit was on harnessing treasury tech and predictive analytics to optimize working capital. Senior finance leaders said the era of passive cash management is over. Today's CFOs must proactively steer corporate liquidity, turning treasury departments into control towers for global finance. Financial technology is playing a transformative role in corporate cash management. At the recent CFO Leadership Council meeting, attendees highlighted how artificial intelligence, AI, and advanced forecasting tools are driving unprecedented accuracy in liquidity planning. Many firms now connect their bank accounts, enterprise resource planning, ERP, systems, and global payment networks via APIs, enabling instant visibility into cash positions across continents. Predictive algorithms flag potential shortfalls or excesses early, allowing companies to rebalance funds seamlessly and reduce idle cash. This push toward real-time treasury operations is particularly crucial for e-commerce giants operating in dozens of countries and currencies. By automating funds transfers and optimizing short-term investments, companies are extracting more value from their cash, what one CFO dubbed turning idle dollars into rocket fuel for growth. Corporate treasurers are also navigating new horizons in digital finance to improve liquidity. Several household name retailers have quietly begun experimenting with stablecoins and digital currencies to expedite cross-border transfers, inspired by fintech advances. They note that using regulated digital dollar tokens can speed up supplier payments to near instantaneous, minimizing costly currency conversions and delays. Scenario planning for multi-planetary transactions is still a thought experiment, but Treasury executives use it as a metaphor for readiness. Just as we plan missions beyond Earth's orbit, businesses are ensuring their capital can seamlessly flow across any frontier. By investing in next-generation treasury platforms and diversified banking partners, CFOs say their teams stand prepared for whatever the future economy, even one stretching into space, may bring next. Legal insight, corporate treasury global tax policy shifts are adding new complexity to corporate treasury decisions. Dozens of countries have committed to a 15% global minimum corporate tax on multinational profits, aiming to curb tax havens and ensure e-commerce titans pay a fair share. While some last-minute agreements, including a U.S. carve-out, emerged in early 2026, finance chiefs are bracing for compliance with these rules as they roll out. Many companies have begun restructuring cash allocations across jurisdictions and updating their tax provisioning systems to meet the new standards. Treasury teams are working closely with legal departments to navigate these changes, demonstrating how strong regulatory awareness is now as essential as technical savvy in corporate cash flow management. 2. Enterprise Risk Management, ERM. AI tools fortify corporate shields amid new wave of global threats. Risk managers across industries are ramping up their defenses as novel threats emerge, from cyber attacks assisted by AI to unpredictable supply chain disruptions. In boardrooms and war rooms alike, enterprise risk management, ERM, is taking center stage this week. Companies are sharing success stories of averting crises by merging traditional risk assessment with cutting-edge tech. For instance, one major online retailer recently thwarted a complex cybersecurity breach attempt by deploying AI-driven anomaly detectors that flagged unusual network patterns within milliseconds. Chief risk officers, CROs, say that agility and foresight are paramount in a volatile world. Integrated risk dashboards now blink with real-time alerts on everything from foreign exchange swings to climate-related disruptions. This proactive stance, essentially becoming guardians at the gate, is earning risk teams a new level of visibility among corporate leadership. Data analytics and machine learning have become indispensable in modern ushering in a new era of predictive risk intelligence. Firms are training AI models on vast datasets to simulate extreme scenarios and identify weak spots in their operations before issues escalate. For example, advanced risk engines can dynamically model the impact of a sudden regulatory change or a materials shortage on a company's global e-commerce sales, helping decision-makers plan contingencies well in advance. Employee-centric risk training is also trending. This week, executives at a global fashion platform credited a comprehensive internal risk culture reboot, teaching staff to spot early warning signals, with saving millions in potential fraud losses. By fostering a culture where every team member is a risk sensor, companies are blending human intuition with technological muscle to create a resilient, people-powered shield against adversity. Even traditionally low-tech risks are getting high-tech treatments in 2026. Financial institutions and retailers are leveraging cloud platforms to centralize enterprise risk data, bringing together credit risk, supply chain exposures, and even geopolitical intelligence onto one screen. Regulatory compliance is increasingly viewed as a core part of risk management, prompting risk officers to collaborate more closely with legal teams. Amid a flurry of unpredictable global events, from sudden commodity price spikes to game-changing innovations, companies stress the need for nimble and integrated risk frameworks. The consensus among experts is encouraging. By investing in smart risk governance systems, businesses are not only protecting themselves, but also creating an atmosphere of trust for their customers, shareholders, and employees, fueling long-term confidence as they reach for ambitious horizons. Legal insight: regulators worldwide are influencing how companies manage emerging risks. The European Union's new AI Act, set to be enforced from August 2026, will require any company deploying high-risk AI systems to implement rigorous risk assessments and transparency measures. This legislation is pushing enterprises to formalize their AI governance frameworks, ensuring algorithms are fair, explainable, and continuously monitored. Stateside, the regulatory environment is in flux. U.S. financial regulators recently proposed rolling back parts of a 2024 climate risk disclosure mandate, sowing uncertainty even as climate impacts intensify. In response, many global companies, especially in retail and tech, are voluntarily upholding robust climate risk reporting and adopting international risk standards to stay ahead. The message is clear. Effective risk management today means staying nimble not just against market threats, but also against shifting regulatory winds. 3. B2B payments and infrastructure fintech. Stablecoins go mainstream as businesses embrace speed of digital money. A payments revolution is sweeping through the business-to-business (B2B) sector, with new data revealing that digital currencies are becoming a go-to tool for companies worldwide. Executives at the Money 2020 FinTech conference in Amsterdam this month were astonished by a report showing nearly 1 in 4 businesses now uses or plans to use stablecoins, cryptocurrencies pegged to stable values like the US dollar, for cross-border payments. In fields from manufacturing supply chains to global e-commerce marketplaces, firms are increasingly relying on stablecoins to pay overseas partners instantly and at lower cost, bypassing slow traditional banking routes. What was once a niche experiment is now mainstream. Another global survey found 64% of businesses either already use stablecoins or intend to adopt them within 3 years, citing faster settlements and cheaper transactions as core benefits. This marks a turning point where digital money moves from speculation to infrastructure, powering business operations much like any other payment network. Behind the scenes, fintech innovators and financial giants alike are racing to modernize B2B payment rails. Major payment networks are expanding their services for business customers, capitalizing on the booming demand for frictionless transactions. In a move grabbing headlines on Wall Street, Visa recently announced a tailored B2B payment platform for trucking and logistics firms, an industry long dominated by paper checks, to digitize fleet payments and fuel purchases. At the same time, Rising fintech stars are attracting big capital. Corporate spend management startup Ramp made waves by raising an additional $750 million this quarter, funding its push into AI-powered accounting and payment automation. These developments highlight an industry shift from manual invoicing and month-long payment terms to an era of instant bill settlement and integrated finance. All this progress in B2B payments is empowering businesses large and small. Cloud-based services now let even mid-sized online retailers tap into real-time global payment networks that automatically optimize currency conversions and liquidity. Suppliers get paid faster and more reliably, strengthening supply chains and enabling small vendors around the world to participate fully in e-commerce ecosystems. Fintech leaders describe this moment as a new frontier for commerce, a comparison not lost on industry watchers who liken the adoption of stablecoins and borderless payments to opening trade routes to new planets. By making transactions simpler and more transparent, the B2B fintech boom is lowering barriers and costs, injecting optimism that the global economy can operate seamlessly across every distance, perhaps one day even bridging commerce between Earth and space. Legal insight: B2B payments as digital payments technology leaps ahead. Regulators are racing to provide guardrails for stability and trust. In the United States, the landmark Guiding and Establishing National Innovation for U.S. Stablecoins Act, dubbed the Genius Act, took effect last year, creating the first federal framework for stablecoins. The law requires that payment stablecoins be fully backed by safe assets like cash or treasuries, and that issuers meet rigorous licensing and disclosure standards. This regulatory clarity is giving CFOs and payment heads more confidence to integrate stablecoins into their cross-border cash management, knowing consumer protections are in place. Similarly, the European Union's MiCA regulation, markets in crypto assets, and updated anti-money laundering rules are encouraging compliance-focused innovation. Fintech firms are responding with robust RegTech solutions to help businesses meet Know Your Customer (KYC) and anti-fraud requirements on digital payment platforms. The upshot: good regulation, while still evolving, is increasingly seen as an enabler, not an obstacle, for the next generation of B2B payment infrastructure. 4. RegTech, regulatory technology, AI versus financial crime, compliance leaps to light speed. A surge of innovation in regulatory technology, or RegTech, is transforming how companies comply with complex laws in an era of data overload. This week, industry insiders report that financial institutions and large e-commerce platforms are rapidly deploying AI-driven compliance tools to keep up with a barrage of regulations worldwide. From automated suspicious transaction monitoring to continuously updated digital audit trails, these systems help companies meet their legal obligations in real time. The stakes are high. Regulators across multiple jurisdictions now expect businesses to detect and prevent money laundering, fraud, and data breaches faster than ever. To answer this challenge, financial compliance teams are embracing advanced software that can analyze millions of transactions per second and flag anomalies far quicker than human staff alone. This smart compliance approach is not just about avoiding fines. It's about building trust with customers and demonstrating corporate responsibility, a mission-critical goal as businesses expand their reach across the globe and beyond. New use cases for RegTech are emerging daily as firms strive to simplify red tape and reduce costs. Automated KYC, Know Your Customer, solutions are trending, with banks and online marketplaces swapping cumbersome manual identity checks for frictionless digital verification. One fast-growing European fintech, for example, recently integrated an AI-powered ID verification platform directly into its app, slashing customer onboarding times from days to minutes. Similarly, large retailers are using compliance automation to monitor supply chains for sanctions or labor law issues, ensuring their e-commerce operations remain ethical and legally sound. Industry analysts note that global spending on RegTech is rising sharply, supported by venture investments and strong demand. Executives describe this as a RegTech renaissance, where companies in finance, tech, and retail are proactively seeking tools to turn regulatory compliance from a headache into a competitive advantage. After all, a business that automates compliance can operate with more agility, entering new markets and launching products faster without fear of crossing legal lines. The embrace of RegTech is also influencing regulators themselves. Governments and agencies are increasingly exploring supervisory technology, SupTech, essentially RegTech for regulators, to monitor markets and companies in near real time. For instance, several financial authorities are using AI to sift through vast troves of trading and social media data to detect unusual patterns indicative of market manipulation or fraud. This collaborative dynamic between industry and regulators is creating a virtuous cycle. As rulemakers get more tech-savvy, they build greater confidence in digital processes, which can lead to clearer rules and potentially streamlined compliance requirements. It's a people-first perspective as well. Compliance software is freeing human experts to focus on judgment calls and ethical oversight, tasks where human insight is irreplaceable. The optimistic view shared by both RegTech providers and corporate compliance officers is that as machines shoulder the drudgery of compliance paperwork, businesses can better focus on innovation and serving their customers, paving the way for a more transparent and inclusive economy. Legal insight, RegTech. The payoff from robust regulatory technology is evident in recent legal outcomes. In a headline-grabbing privacy case this spring, Amazon successfully overturned a record €746 million data protection fine after convincing a European court that it had dramatically improved compliance practices. The e-commerce giant's victory, following extensive enhancements to its data privacy controls and transparency measures, illustrates how strong RegTech deployment can directly mitigate legal risks. Meanwhile, enforcement trends underscore that the regulatory bar is rising. Data shows global regulators have issued over €7 billion in fines under privacy and financial crime laws since 2018, peaking through 2025. This has propelled companies to invest heavily in compliance automation and analytics to avoid missteps. Whether it's meeting GDPR privacy mandates or keeping up with new anti-fraud and consumer protection laws, businesses see RegTech as their launchpad to not only meet legal obligations, but also to foster a culture of accountability and trust in customers' eyes. 5. Institutional trading and market infrastructure. Wall Street preps for 24/7 liftoff as markets embrace new horizons. The world's trading floors are on the cusp of a historic transformation as stock markets inch closer to continuous, around-the-clock operations. In a bold step forward, U.S. regulators have approved plans for major exchanges like Nasdaq to extend their trading sessions dramatically, nearly bridging the gap to 24-hour weekday trading. Starting later this year, Nasdaq will introduce an overnight night session, boosting total trading time for stocks and ETFs to 23 hours each weekday. This unprecedented move, aimed at accommodating investors across global time zones and competing with 24/7 cryptocurrency markets, is electrifying institutional trading circles. It means that traders in Asia, Europe, and the Americas can interact in U.S. markets with minimal downtime, fundamentally redefining market infrastructure for the always-on digital age. Analysts are already dubbing it a new dawn for markets, comparing it to opening a trading post on a new continent, or even another planet that never sleeps. The push toward 24/7 markets is part of a broader modernization of institutional trading tools. Algorithmic and AI-driven trading systems dominate volumes on exchanges today, executing the majority of global equity trades with superhuman speed and precision. Data released this week shows algorithmic trading volume has surged so much that it now accounts for roughly 2/3 of all U.S. equity trades, freeing human traders from rote tasks and focusing them on higher-level strategies. Advanced trading algorithms can react to market-moving news in milliseconds and operate nearly continuously, seizing opportunities even in the middle of the night. This has encouraged exchanges worldwide to consider extended hours and improved connectivity. Major market players are investing in infrastructure upgrades, from faster data feeds to new clearing processes, ensuring that a trade executed at 3 a.m. can settle as seamlessly as one at noon. The infusion of ultra-modern tech into market plumbing is boosting liquidity and could smooth out volatility by spreading activity over more hours. The implications for investors and businesses are profound. For global e-commerce companies and retail investors, near-constant market hours mean the ability to adjust portfolios or hedge risks at virtually any time, just as online stores remain open 24/7. Some veteran traders admit the idea of continuous trading is an adjustment, but many are optimistic that it will democratize market access, giving participants worldwide equal footing regardless of their local clock. Institutional investors, in particular, see potential for improved risk management, the chance to respond to overseas news or overnight developments immediately. While concerns about after-hours liquidity and oversight remain, most industry voices are treating these changes as an inevitable next step. In an era when humanity sets its sights on new frontiers beyond Earth, our financial markets are evolving in tandem, striving to become as boundless as the digital economy they serve. Legal insight. Trading infrastructure regulators are carefully overseeing this evolution in market structure to ensure stability and fairness. The Securities and Exchange Commission, SEC, by greenlighting extended trading hours, signaled its support for innovation while imposing safeguards to protect investors during overnight sessions. Regulatory bodies are also paying close attention to the rise of alternative trading platforms using blockchain and other novel technologies. A notable example is Polymarket, a crypto-based prediction market platform that recently enabled its first institutional-sized trade after the Commodity Futures Trading Commission, CFTC, allowed its U.S. operations under stricter compliance. Originally fined and barred for operating unregistered markets, Polymarket has since worked with authorities and now operates with regulatory oversight, highlighting regulators' willingness to bring new market innovations into the fold rather than shut them out. As trading goes high-tech and near-continuous, expect ongoing coordination between industry and regulators, from updated market conduct rules to new risk controls, ensuring that this space-age trading era remains transparent and secure for all participants. Disclaimer: this report is for informational purposes only. Nothing in this news report constitutes legal, financial, medical, or official advice. The stories presented here reflect current industry developments and commentary. They should not be interpreted as personalized guidance or recommendations. Always consult professional advisors for advice tailored to your situation. Video description. Join us for Financial Frontiers, June 15, 2026, a forward-looking news report covering 5 major developments in global finance and e-commerce. We explore how CFOs are using advanced tech to revolutionize corporate treasury and cash flow management, how companies fortify themselves with AI-powered enterprise risk management, ERM, solutions, and the rise of B2B payments innovations like stablecoins transforming global trade. Our report also dives into the RegTech boom, showing how AI and automation are combating financial crime and easing compliance burdens, and examines the future of markets as institutional trading infrastructure adapts to near 24/7 operation. With a positive, futurist outlook, we highlight how these trends are empowering businesses and people, bridging global markets, maybe even foreshadowing a future of commerce without boundaries. Disclaimer: all content is presented as news and analysis. It is not financial, legal, or medical advice. Video tags.